Hey Utah, it's Stinko the Realtor with another market update, and there are a lot of things unraveling in the economy right now that can impact the housing market and speed up the housing correction that we're currently in. So I want to first show the mortgage application data sank 14.2% the last week of September. Now this is a little misleading because it also takes into account the refinances, so it hit the lowest point since 1997. And even if it is a little misleading because it's calculating the refinances, the population is much bigger here in 2022 than it was in 1997. So it's still a big concern that mortgage applications are actually hitting those lows, and the mortgage purchase applications are also down. As we can see here, the combined refinance and purchases are down 69%, with refinances being lower 86%, and the purchase index has fallen for the mortgage applications 39%. Now that is the one we need to focus on a little bit more, because that's actually the demand for houses and impacting the housing market. So if there was 100,000 people nationwide applying for mortgages last year, there's only 600,000 applying for mortgages right now. And then when they do apply for those mortgages, because of those high interest rates, less people are actually able to get pre-approved, meaning they can actually go and shop for a house saying, hey, I have a letter from a lender stating that I'm qualified and able to buy. And also some people that do get that pre-approval letter, they get a payment shock and go, whoa, with these home prices and with these interest rates, I'm just going to sit on the sidelines. So it's actually worse than that 39% indicator, because more people are now sitting on the sidelines that are applying for those mortgage applications, which means that the buyer pool just keeps shrinking and shrinking and shrinking, and inventory is just going to continue going up, plus the new construction inventory that's about to start hitting the market here in the fall and in the winter. And then we're going to have existing homes hitting the market again at the beginning of next year into the spring. So definitely keep an eye out on all of that. And I want to share this other article. It shows that there's a 29% drop in purchasing power since January of 2021. Now, here is a house that was $2,500 monthly payment. You were able to buy a house at $550,000, and now it's almost $375,000 just because of the interest rates going up. And this is also not taking into account the insurance going up and the property taxes going up. Plus on the property taxes, there's a delay by the time the appraisers and the counties and the state finalizes this stuff. So the affordability is actually even worse than that 29% when you start adding the other data in. And that's why we are seeing a nationwide correction on housing prices, and the areas that appreciated faster are going to be depreciating sooner. And people are saying, hey, I'm hearing all this stuff that that the housing market is going to crash, correct, but I don't really see it being that big. Well, remember the article that I showed y'all with the charts on the last video, I believe it was, or one previously? Go back and watch that. It took a couple of years for that stuff to unravel, and once it did, it took another year and a half for the markets to start bottoming out. And the ones that appreciated much faster are also the ones that appreciated much faster. If we take a look at Seattle here compared to San Francisco, it appreciated slower, and it actually took a couple of years to bottom out. And every market that appreciated faster also depreciated sooner. So that's stuff to keep in mind. And Denver here is a good indicator of our Salt Lake, the Wasatch Front market, because we didn't get affected as much back in 08-09 because the market didn't appreciate as much. However, now we're one of those markets that appreciated and skyrocketed, kind of, for example, like Phoenix and Las Vegas, where we just went up. And this is across the entire nation now, where a lot of markets went up. And remember in that previous video, the market was actually slowing down in August, September, October of 2021. And interest rates at that time were in the low threes. And we were seeing the correction, but then we had the Omicron variant. We decided to actually increase the tariff on Canadian wood 2.5 times. And people were saying not to do that, but the politicians did it. And then we had the supply chain issues, the China zero COVID policy, and all of that impacted 2022 to be worse than 2021. So if there was a correction at a 3% interest rate going on where the housing market was slowing down, what's going to happen now as interest rates have skyrocketed and as inventory is starting to go up and up and up? So those are things to keep in mind. And they're saying that the consumer is prepared for what's happening, and we're in a great shape and people have savings. Well, those savings are getting depleted. As we see here, the credit card debt has jumped $100 billion or 13%. That 13% is the biggest increase in more than 20 years. So people are having to tap into their savings or use their credit cards because they don't have that money. So all of that money that was set aside, Americans are in a better financial situation than they've ever been before. Well, that only lasts for so long. And the reason I say that is, let's take a look at this chart here, this little graph. At the beginning of 2020, when the pandemic was just happening, the shutdowns were happening, Americans were saving at a 35% rate, which was the highest of all time, and it was 1.6 trillion. And that's a lot of money. However, 1.6 trillion divided by 129 million households in America is only like $12,000 or $13,000 per household. And you can run through that in a month or 2 or 3. And if you're tapping into that in a couple of months, you're pretty much going to deplete that savings that you had. And as we see here, it started going down to savings, and then it kind of went up a little bit here at the beginning of 21, and then it just started plummeting. And they consider this 8% right here to be the average and to be a healthy savings for Americans. And as you see, we've been running since the mid 2021, we've been running below that and quite below the last 6 months. And the last 6 months has been a 3.5% savings for an average American. So there's definitely not a whole lot of money that's just sitting on the sidelines that's ready to help Americans once the recession takes into place. And as I've been stating in my other videos, definition of a recession is 2 negative GDP terms in a row, and we've had that. That's been in my econ classes, that's been in my econ textbooks, and I don't know when the recession definition changed or what it is anymore, because we're going into a recession, but technically we're in it. And I want to show you all this article. So right here, the World Bank says that the risk of a global recession in 2023 rises, and as we're seeing simultaneous rate hikes. Now, we take a look here. Central banks across the entire world are fighting inflation, and if the US housing bubble of 08-09 can cause a global recession, well, if the entire world is in a global recession, then that's going to further impact of what's happening here in our economy. For example, the UK, we saw in the news, they're doing really, really bad. Canada is actually doing worse here than they did in 08-09, and it hasn't even fully unraveled yet. And Canada, I believe they are our number one, if not, I know they're in our top 3 trading partners, and the UK, I believe, is our top 10 trading partner. And of course, Germany is going to be affected. There's the war in Ukraine. There's all of this stuff unraveling. The car bubble where people paid above MSRP when they bought these new cars, or they were buying cars that were a year or 2 old for the same price that the new ones were being sold. Well, as that stuff fixes itself, somebody gets in a car accident, loses their job, they can't cover that loan that they have. Now they have to figure out, and the insurance is only going to cover X amount unless they have gap insurance. And if a car gets repoed, now that lender, that bank, is going to have to take a loss, and we're probably going to see a bigger impact of that in the recession. So the global recession, the macroeconomics, the microeconomics, it's all the stuff that we have to look at. Just like how fear can drive the market to go up, we can also drive the market going down, because people are going to start getting skeptical. The fear is going to set in, and offering $50,000 or $100,000 above list price, they can just flip that on the other side. And once it hits the news media, the social media, the fear alone, as we see here now, the talks about a correction, the Fed coming out and saying they're going to do that, has slowed the housing market down. So just the information out there alone. So even if all of these things don't hit, if they do hit, it's going to be catastrophic. If there's just the dominoes fall. But if just half the dominoes fall, it's still going to be pretty bad. And we have so many dominoes that even 1 or 2 or 3 of them falling is going to impact the housing market. So make sure you hit that subscribe button. That way you're kept up to date with what's going on in the housing market and the economy that's going to impact the housing market. Hit that like button, leave a comment down below what you think is going to happen with the housing market. And thanks so much for watching. And until next time, have a great day.